This new indicator stands out remarkably. The trend cloud displayed here relies on core price action principles. It draws from shifts in market character and breaks in structure. Among TradingView's trend tools, this ranks highly. Let's apply the indicator now, and I'll guide you through its application. To get started on TradingView, select the Indicators menu and type BOS Adaptive Structure Average. Then pick the version by Zierman. There it is, overlaid directly on your price chart. And like typical tools that depend solely on price data and basic math, this one employs market structure analysis. It spots breaks of structure and changes of character to fine-tune the central average line, forming the trend cloud visible across the chart. Thus, the average and cloud respond not just to raw price shifts as with standard moving averages or regression channels, but to confirmed structural shifts via breaks and character changes. This yields a dynamic line and cloud offering sharper, more adaptive market insights. The indicator also marks detected breaks of structure and changes of character right on the chart, alongside the average line and the trend cloud. Now, before diving too deep into how you can use this to spot trading opportunities, let's briefly review the concepts of change of character and break of structure, in case you're not yet familiar with them. Change of character, labeled CHoCH, signals the likely end of the current trend and the possible start of a new one. It is sometimes referred to as a market structure shift. For example, in this section of the chart, price forms higher highs and higher lows, which defines the structure of an uptrend. As long as higher highs and higher lows continue, the market can be considered to be in an uptrend. Yet, if a candle closes below the most recent higher low, the prior uptrend structure is broken. That suggests the uptrend may be ending and a downtrend could begin. When this last higher low is breached, that moment is called a change of character and is marked CHoCH. Note that this is an initial signal only. Deciding on a reversal or entering a trade should be supported by additional confirmation, which I'll cover next. From that point, you can usually see price transition into forming lower highs and lower lows. This defines the structure of a downtrend. As long as price continues to make lower highs and lower lows, the market remains in a downtrend. However, if the most recent lower high is broken and a candle closes above that level, the structure of the downtrend is considered broken. This signals that the downtrend may be ending and an uptrend could be starting. When price closes above the last lower high, this again qualifies as a change of character and is shown as CHoCH, indicating a probable reversal in the market. Now let's move on to BOS, which stands for break of structure. When the market is in a downtrend, price forms lower highs and lower lows. After a new lower low is formed and price pulls back, that low can act as a potential support level. Price may struggle to move past that level. When that low is finally broken and a candle closes below it, this is called a break of structure and is marked BOS. It acts as a signal that the price is likely to continue moving in the direction of the downtrend. During an uptrend, as described earlier, price forms higher highs and higher lows. After a new higher high is formed and price pulls back, that high can act as a potential resistance level. If that level is then broken and a candle closes above it, this is also called a break of structure and is shown as BOS. It signals that the price is likely to continue moving in the direction of the uptrend. With these core price action concepts understood, you can see how this indicator builds its average line and trend cloud around them. It adapts to the current market state, so you can expect it to respond closely to real-time price action. When the market is trending down, price typically stays below the average line, and the cloud turns red. When the market is trending up, price generally stays above the average line, and the cloud turns green. This indicator can be used in two main types of trading strategies: trend following and reversal trading. In a trend following strategy, the cloud helps identify the direction of the trend, and you can then look for entries on pullbacks. For example, when the cloud is red, the market is in a downtrend, so you can look for short side opportunities on pullbacks. You can use price action patterns and confirm BOS signals to time your entries or pair this with a buy-sell signal indicator, focusing only on sell signals in a red cloud environment. When the cloud is green, the market is in an uptrend, and you should look for long side opportunities on pullbacks. Again, you can combine price action patterns with BOS marks or use a buy-sell indicator but only take buy signals in this context, and a reversal-focused strategy. The change of character is the key signal that a shift in direction may be starting. When you see a CHoCH signal alongside a red cloud, it suggests that the uptrend may be reversing into a downtrend. You can also add a momentum indicator such as RSI to confirm this. For instance, before the CHoCH appears, RSI may show a bearish divergence, where price makes a similar high but RSI prints a lower high. This reinforces the idea that a reversal could be in progress. Combining RSI divergence, a CHoCH mark, and a red cloud gives you three aligned signals pointing to a potential reversal. Even then, it is wise to wait for a pullback to see how the market balances upside and downside momentum. The reversal is genuine and downside momentum dominates. The advance will stall and price will move lower. A strong confirmation that the pullback is over and the downtrend is strengthening is a BOS signal, where price closes below the recent low. That gives you higher confidence that a downtrend is forming. Similarly, after a downtrend, a CHoCH combined with a green cloud can indicate a shift into an uptrend. If you also see a bullish RSI divergence, price makes a lower low while RSI forms a higher low. This adds to the evidence of a reversal. With these three signals in place, you wait for a pullback to see whether upside momentum exceeds downside. If it does, the decline halts and price moves higher. The best low-risk confirmation is again a BOS signal, where price closes above the recent high, indicating that a new uptrend is likely forming. It is important to remember that no trading strategy or method can offer guaranteed signals. Risk management is essential to keep the impact of losing trades under control. The 1% risk rule is widely recommended by professional traders, as it limits the amount you risk per trade and helps protect your account over time. Applying this rule consistently, along with clear stop-loss levels and profit targets, builds a solid foundation for long-term trading success. The more consistent you are with your method, the better your long-term results will become. Consistency in entries and risk rules turn small edges into significant profitability over time.